Okay, let's unpack this a bit. Today we're diving into an options strategy called the Iron Condor. This deep dive is really all about understanding how it works, what makes it attractive, and the crucial details from the sources you shared. Our mission is basically to demystify this, well, potentially powerful tool for generating income in specific market conditions.
Right. And what's fascinating here, I think, is how this strategy offers a defined risk and reward profile right from the get-go. That's a major draw for a lot of traders. We'll explore its structure and, why it's often a favorite among professionals looking for that consistent premium collection.
Okay, so when we talk about an Iron Condor, what exactly is this strategy at its core? And why is it so appealing in certain market conditions?
Well, at its heart, an Iron Condor cleverly combines two foundational option strategies. You've got a bear call spread to manage your upside risk and a bull put spread to handle the downside risk. Put them together on the same underlying asset, same expiration date, and boom, you have the Iron Condor. Its core purpose is really to profit if the underlying asset, like a stock or index, stays within a specific price range, the Condor body, until expiration. And what's really crucial here for you to grasp is that you're looking at clearly capped exposure. You know your maximum potential gain and your maximum loss right from the start. It's a neutral strategy.
So you're kind of building a financial fence around the stock price, hoping it stays put inside. And that capped exposure, that's a pretty significant draw, isn't it, compared to, say, selling naked options?
Precisely. Yeah, exactly. So to visualize the structure, you're actually creating four legs, four different option contracts. You sell an out-of-the-money call that's a call with a strike price above the current price. And at the same time, you buy a call that's even further out of the money with a higher strike. That pair is your bear call spread. It caps your risk if the stock suddenly surges upwards. Then you do a similar thing on the other side with puts. You sell an out-of-the-money put strike price below the current price, and you buy a put even further out with a lower strike. That forms your bull put spread, which protects you if the stock price tanks.
Okay, so it's four distinct options all working together. And the core idea, the profit engine, is that you're collecting premiums from those two options you sold, right?
Yeah.
The short call and the short put.
Exactly right. Your maximum possible profit is simply the total net credit you receive upfront when you put on the trade. That's the money from the options you sold minus the cost of the options you bought for protection. Your maximum potential loss, on the other hand, is the difference between your strike widths. So the distance between the two call strikes or the two put strikes, they're usually the same minus that initial net credit you received. And you also have two break-even points. Those are the price levels where you start losing money. It's the short put strike minus your credit and the short call strike plus your credit.
Okay, theory's good, but let's make this more concrete. The sources gave a pretty clear example using SPY, the S&P 500 ETF. If SPY is, say, trading at $500, how would an Iron Condor actually look?
Yeah, good example. Let's use that. If SPY is right at $500, you might set up an Iron Condor like this. You sell the $490 strike put, and you buy the $480 strike put. That's the bull put spread. Then on the call side, you sell the $510 strike call and buy the $520 strike call. That's the bear call spread. Now let's imagine you collect a total net credit of, say, $3 per share for setting this up. That's $300 per contract. Since one contract controls 100 shares, your maximum profit here would be that $300. You get that if SPY closes anywhere between $490 and $510 at expiration, right in that sweet spot. Your maximum loss would be $700. How do we get that? It's the $10 spread with the difference between $490 and $480, or $510 and $520 minus the $3 credit you collected. So $10 minus $3 gives you $7 times 100 shares is $700. And your break-even points, where you transition from profit to loss, would be $487 on the downside, $490 short put strike $3 credit, and $513 on the upside, $510 short call strike plus $3 credit.
Okay, so if it stays between $490 and $510, you keep the full $300.
Yeah.
If it goes outside $487 or $530, you start losing, capped at $700. Seems clear. That really brings us to the why, though. Beyond just how it works mechanically, what really makes the Iron Condor a go-to strategy for, more experienced traders? What's the deeper appeal?
Well, there are a few key reasons. First, it's a powerful income generation tool, especially when used on broad market indexes like the SPX, RUT, or NDX. Experienced traders are strategically using theta, which is the time decay of options. As time passes, assuming the price stays stable, the options you sold lose value, which works in your favor. Many pros aren't even aiming for max profit. They often look to capture, say, 50% to 70% of the initial credit and then close the trade early. This helps avoid the risks that pop up closer to expiration, like gamma risk.
Right, so it's less about hitting a home run and more about consistently getting on base by letting time decay work for you. And it's perfect if you expect the market to just tread water.
Exactly. It's designed for a range-bound outlook. It performs best in low to moderate implied volatility environments, when the market isn't expecting huge price swings. If implied volatility is really high, the expected moves are bigger, making it harder for the price to stay within your chosen range. And why indexes? Well, they tend to be less volatile than individual stocks. They're cash settled, meaning no actual shares change hands at expiration. It's all settled in cash, and they typically don't have early assignment risk. That's a big plus.
Makes sense. But no strategy is foolproof. Every approach has its Achilles heel. What are the main risks, the primary pitfalls someone using an Iron Condor needs to watch out for?
The number one risk is a market breakout. If the underlying asset makes a strong, sustained move either up or down, going past your short put or short call strike, your losses can start adding up quickly, heading towards that maximum loss. Another thing is volatility expansion. Sometimes, even if the price doesn't move much, if the market expects bigger moves in the future, if implied volatility spikes, your position can show a paper loss because the options you sold become more expensive. And while it's less of a concern with those cash-settled indexes, there's always assignment risk on the short options if they go deep in the money before expiration, especially with stock options.
Okay, so managing those risks seems just as important, maybe more important, than setting up the trade perfectly in the first place. So what are the key things pros do? How do they navigate these challenges and actually make the Iron Condor work consistently for them? Any key tips?
Discipline and active management are absolutely paramount. As I mentioned, pros very rarely hold these positions all the way to expiration day. They typically have a profit target, maybe 50% or 70% of the maximum potential profit, and they close the trade once that's hit. Get in, get the target, get out. They're also not afraid to adjust the position if the market starts moving against them. This might mean rolling the strikes up or down or out in time or adjusting the wings, the long options to manage the risk. The goal is consistent income over time, not necessarily squeezing every last penny out of every single trade. Some key tips often mentioned. Give yourself enough breathing room by setting your short strikes reasonably far from the current price. Look for high probability setups, maybe aiming for a 70–80% chance of the price staying within your short strikes, and definitely be cautious around major known events like company earnings reports or big economic announcements, as those can cause sudden, unpredictable volatility spikes that wreck a range-bound strategy.
Right. So wrapping this up, what does this all mean for you, the listener? The Iron Condor is essentially a neutral income-focused strategy. It's designed for those sideways or range-bound market conditions. It offers that really attractive feature of defined risk and defined reward up front. And it's a prime example of how traders can leverage time decay, especially, it seems, on liquid index options where management is a bit cleaner.
Yeah, exactly. And thinking about that management aspect, it really raises an important question. Given how much the Iron Condor relies on that range-bound outlook and how actively pros manage these trades, how do experienced traders actually determine the probability of an asset staying within a specific range? What indicators or analysis tools are they relying on to find those high probability setups? And maybe just as importantly, what alternative strategies might they pivot to if their market outlook suddenly shifts away from neutral?